Welcome to the Performance Banker Podcast. You'll hear banking industry experts providing unique insights and expertise to help bankers achieve higher performance, obtain outstanding results, and gain a competitive advantage. Here's your host, Tonya.
It's so good to have you back here on the Performance Banker Podcast with me today. Carissa is with Constant.ai, which is a loan servicing and loss mitigation tool. In my opinion, Constant is the future of loan servicing. They turn your loan servicing tasks that you do in the back office into automated efforts and tasks so borrowers can self-serve. They do this without replacing your existing systems. So if you want your customers to be able to self-serve on so many of those manual tasks that we often send from the front line to the back office, which typically takes anywhere from 24, 48, 72 hours for them to turn back around to us or get back to the customer, this tool is something that you need to take a look at. If you want your lending team or your call center staff or your frontline tellers to be able to give payoff quotes and to do them accurately and to give all of the proper disclosures, again, this is a tool that you need or at least take a look at. The compliance departments, I have to tell you, they love this tool. But today we're going to be talking about delinquencies and how to prepare for the next few quarters. Again, Carissa, I can't tell you how excited I am to have you back on the podcast today.
Likewise, thanks for having me. There's so much to talk about, lots going on in the industry, so really excited to dig into it.
Yes, I'm so anxious for this conversation to take place. And I know that we have a lot of listeners that are bankers. We have some that are just consumers out there who like to learn about what's going on in banking. There's so much that we try to give about financial literacy as well. So I know that today's topic is going to hit both the consumers that listen as well as the bankers and what they need to prepare for that's coming up in the next few quarters. So let me go ahead and ask you our first question. So what does the rest of 2022 look like, Carissa, from a credit risk and delinquency perspective?
Yeah, great question. And I think it's one that folks are struggling with from the lending side, from the credit risk side, and also in the operational aspect as well. And the reason for that is there's a lot of moving pieces to answering that question. So delinquencies are still super low, especially exiting that pandemic era. We're not seeing drastic upticks in any of the particular buckets, but there are some trends that are starting to just raise awareness or kind of sound an alarm like, hey, let's pay attention to these particular attributes. So before I dive into those kind of trend points that are making people look twice, it's really important to just kind of level set that the sky is not falling. There is time, there's information, there is data, and there's plenty of time to implement strategies. It's just the time to start looking at, if it goes this way, are we prepared? Or if it goes in a totally different direction, are we prepared to meet those kind of consumer demands and expectations? So one of the things that's been interesting is there's been a few articles around upticks in foreclosures and repossessions. So if you look at that as a percentage increase year over year, you'll see these drastic numbers, 140%, 160%, but it's because you're comparing that to literally no activity in most of those buckets because of the moratoriums and the consumer protection efforts that were in place to kind of thwart any negative delinquency consequences against a consumer. So as those started to lift and expire, we saw forbearance plans expire, moratoriums started to lift. That's where we started to see an increase in activity at the federal level for foreclosure and then also at the state level for repos. But it's nothing that's overwhelming. It's just important to know, like there are folks that are losing collateral, they are losing their homes, they are starting the legal process again and kind of facing the consequences of non-payment. And that's just a drastic shift from what consumers have been experiencing for the last 2 years as we were navigating through the pandemic. So on the foreclosure side, and this is where I spent the majority of my career in the Great Recession, was loss mitigation and foreclosure. And so we saw folks going through hardships, trying to list their homes on the market. The difference now is the equity and the collateral that's still available. So you look at real estate prices, they're super high. But also you look at rental prices, those are super high. And so the people that are going through foreclosure are looking at really difficult decisions of, I can't keep my home, I can't afford to keep my home, but what does my housing alternative look like? And we're starting to see a little bit of activity tick up in all 50 states actually for that foreclosure bend. Again, they're not drastic. It's nowhere near the recession peaks, but it's certainly a significant trend since we're exiting the pandemic levels. The same is kind of true on the repo side. So collateral, there's a supply and demand issue again in the auto market. We've personally visited dealerships, and there's not a lot of activity there for new cars, and so there's value in used vehicles. When folks start to feel pressure, they still have room to be able to liquidate that collateral and pay off their loan. So it's just something to be mindful of, that despite the equity that appears in most markets for most collateral secured loans, we're still seeing negative consequences like foreclosure, like repossession start to tick up. So it's just another piece of information that's worth noting and paying attention to from a strategic perspective.
So I'll make a couple of comments here. We sold our home back, in August will be 2 years. At that time, we took, a major loss on selling our home. It wasn't long after that, then, the housing market went up. So we were like, gosh, dang, we wish we would have waited. Yeah. And then, and now, we've been doing the apartment living for quite some time. And now it's time for us to renew the apartment lease. And our apartment rent is going up $125, now. And so we are, we're in a situation where, we've gone from 4,000 square foot home to a 1,300 square foot apartment. And we're paying, I was thinking about this last night because I was thinking about the podcast today, and $500 more a month in rent for 1,300 square foot apartment over our 4,000 square foot home. It's just crazy. And so, I start thinking about people who are building, right now, and you talk about equity that people have in their homes and they're selling. There's some people that have gotten some really good pricing out of their home, and they have downsized. And, so it's been great for some people. People that have bought, I thought, my goodness, how in the world have they afforded what they're purchasing? And I think, to what you're going to be talking about, repossessions, past dues. I've thought through all of that again, last night, preparing for today, and wondering, the impact on those people, and not even right now, but even into next year and the year following, because we don't know what's coming up.
Exactly.
And so, and I know you're going to speak to some of that, but, and then a comment that I'll make on, vehicles. I know, and my dad, for example, my mom just mentioned, she was here last weekend, and she was talking about how my dad continuously gets letters of the company who he bought his vehicle from are wanting to buy back, his vehicle. And there's some people that have gotten some really good deals on some used cars. And then there's some people who have sold back, their vehicles and have gotten some good deals. So, there's two sides to this situation.
Absolutely. And we talked about this back in late 2020. We were talking about the K-shaped recovery. And there will be some folks that really benefit or come out on a more positive side. And there are others that are going to really struggle. And we saw a little bit of a reprieve on both ends. And now it's not a guarantee. I think when we talk to a lot of FIs and they're on both sides, they are increasing their loss reserves a bit in preparation for the final quarters of 22. But they're not overly concerned because they are also watching the delinquency trends. So the challenge is you're dealing with the record high inflation. Everything costs more, right? And it's not just one particular type of debt or one particular type of expense. Everything has increased, and the job market is pretty steady. But the increasing in wages and the adjustments for wages is not actually keeping up with the record inflation. So there was an article that we might have reached peak inflation, and now we would start to see prices go down. But to your point, it's just evaluating, especially as a consumer, what does the next few quarters look like for me and the collateral that I have, and can I afford that? And if I'm on, you mentioned excessive equity in homes, a lot of people took that equity out and did home improvement projects. We've seen that before, right? In the Great Recession, where the loan to values were kind of maxed out, and a lot of folks were in adjustable rates on home equities. So there's been an increase in home equity activity, refinancing of first mortgages because the rates were so low. And now we're seeing the Fed start to increase the Federal Reserve rate and thus the interest rates to kind of curb that inflation risk and slow spending, slow borrowing, in an effort to kind of bring down those prices of consumer goods that are being purchased and financed. So it'll be interesting to see how that all pans out, especially with folks that are in the adjustable rates. And we'll talk about that at the end and with the consumer impacts, but increase in credit card debt. We borrowed as a country, we borrowed a lot of money as consumers in the last several months. And so that all has to be paid back. And the combination of inflation, increasing interest rates, especially for variable rate products, the amount of debt that was financed, the government taking away those stimulus programs that were kind of influencing or positively contributing to households, those are gone now. Changes to small business and commercial regulations. It's just, there's a lot going on, and each one of those components applies a little bit of pressure to how we manage debt as consumers, and then also how the banks manage that debt when that consumer need starts to tick up and they need a little bit more assistance.
Totally agree. So and we've talked about this just a little bit, but going into that second question, what are some additional implications that these market projections that the financial institutions, should be on the lookout for?
Yeah. So again, multiple things to look at. And I always try it should not be a scare tactic, right? It's just awareness, right? Start to just kind of keep an eye on things that are moving. So we'll talk about the credit risk of existing and newly originated debt, because a lot of folks refinanced and a lot of folks purchased in the last couple of years. I can't remember the percentage of increase, but it's fairly significant on, we called them COVID toys, boats, RVs, ATVs.
Yes.
People were investing in things that they're not going on vacation. And so how do we get some entertainment into our life? And we saw a big uptake in origination there. Now, when those were originated, there were three major things going on in the market. One was anyone with a student loan was not having that installment reported against their debt to income, right? Or any defaults were not being reported. And then you had the stimulus components. And so those combinations caused an inflation. I remember a stat from Equifax that it was about 23 basis points, I believe, that FICOs were kind of artificially inflated because of all of the suppression of reporting and other factors that were going on in the market. So when you think about that, you had a lot of folks originating their credit, especially if you're a lender that does risk-based pricing, that could have been 23 points higher, not basis points, 23 points higher on their FICO than had they originated, in 2019 or even, in the subsequent quarters in 2022. So that's important to just understand of how, if you're doing credit monitoring, and especially if you're a FICO dependent credit policy model, how has that shifted from the borrower you thought you originated to what is repaying you now? So there may be some embedded credit risk there as student loan payments start to be called for, even if I know there's a lot of political discussion on restarting and not penalizing them for defaults and just allowing them to continue to pay, but the installment is coming due, and that's going to be part of their debt obligation and their relationship between debt to income. So that's something to just be mindful of. On now, there's a lot of debt with a lot of different lenders, and that customer touch point, that ability to answer the phone, the ability to give answers and direction, to really have an understanding of the reason for default and the pathway to curing that default, is going to be a really big differentiator on who gets paid first, and who's going to really be able to answer that call or initiate that self-service opportunity, and who's going to be sitting on hold for 45 minutes because everybody's calling in. Okay. So that kind of macro assessment is one thing to consider. The other, and it's kind of directly related to that, is if you think about an increase in activity, call activity, just customer need, it could be in your branch, it could be on your phone channel, and you don't have self-service solutions, you're going to have to staff for that. That's where I think folks are nervous. Again, the job market's pretty good right now. So people are being hired at the same positions with competitors at 20 to 30% more than what they were making with their existing employer. So the cost of labor, especially in operations and financial services, I think pretty much everywhere is higher. Right. So one, you're paying a little bit more for these manual, kind of for the FTE that are supporting manual processes. The second, you have to figure out retention because it's super competitive. Absolutely. And the third is, can you even find them, right? So that's the preparation piece, that if we start to think about the strategy and where this economy may shift or move in the next couple of quarters, is your operational readiness prepared for an influx in volume, or is it dependent on being able to hire and train resources? Can you find them? Can you afford them? Can you train them? And again, I started my career actually as a collector when I was in college, and then moved into executive positions. So I felt the burn on both sides. You've got customers that are desperate for immediate answers. You've got high phone volume, backlogs, manual processing, which as the person responsible for communicating that borrower is stressful. And then on the executive side, you've got loss projections and shareholder expectations and compression on your origination revenue. And so this is really like a dance of how to preserve margin. And so it kind of takes just consideration of all of the different aspects that could cause OpEx expenses to increase and compromise margin, or origination volume to decrease and compromise margin, because again, the interest rates are going up. We're already fairly overextended as a country with consumer debt, and just this kind of weariness around the ability of consumers to manage through what the next couple of quarters look like against inflation and rising interest rates. So that's where that, we always are, and I've done it manually for over a decade. That's where the reliance and the preparation on technology and self-service of get these borrowers answers quickly and correctly can make the difference in how we navigate and how we recover if we do see a blip in, third quarter, or heading into the holiday season when, we're already up here for credit card borrowing, and then we're going through the summer, kind of goes like this, and then we go into the holiday season, and you see compression again. So there's just a lot to look out for, and we don't know how much consumers will need us this year because the government had stepped in last year with stimulus packages and refunds.
Right.
We just don't know. We don't know what they're going to need, how they're going to feel about managing all of the debt when it comes due, when forbearance plans expire, and then also managing that just against day-to-day cost of living.
Right. Carissa, we talked about staffing, the last time you were on my podcast, but staffing, is extremely critical when we as banks go through these various types of fluctuations with things that go on in the economy. And, just in my role as a consultant, I see the staffing situation frequently. People are really struggling to not only get staff, but to keep staff. And like you say, they get them, train them, and then a competitor hires them.
Sure.
And so specifically too, I'm seeing that in call centers. So banks today are having to go to the work at home call center environment. Never in a million years would I have thought that would even become a thing. And
100%.
Yes, it's amazing to me. In fact, yesterday I was in a meeting at a business, and about 97% of that business has become work at home. And again, never in a million years would I have thought that, but it had to become that way to retain the employees. Right. So, the environment has just changed so much, but we're talking about self-serving the customers and offering tools to where the customers can get to the information quickly that they need so that they're not having to call into the bank and do what I talked about early on is, come to the bank, fill out a form. The form goes to the back office, and then the back office does all the manual labor to get the information either back to the customer or back to the front line, who then calls the customer to get the information out. And I know that there's still so many banks that are operating under that environment. And so talk to me just a little bit before we go into our third question. Talk to me just a little bit about the process or how easy it is for a tool like this to put in the compliance component or the monitoring component of how simple it is to provide the information to the front line, such as a teller, such as a loan assistant, such as the lender, to where the information that back 3 years ago, we wouldn't even dare think of allowing those individuals to give out certain pieces of information that we would put on a document and send to the back office operations team, where today, using a technology piece like Constant.ai, to where our security team, our compliance team, the CFPB, the FDIC, the state, they're all just, singing praises to someone like you all to offer this type of technology. And let alone the customers are at home being able to look at this on their mobile or their computer and saying, thank God my bank has come up with this technology to where I don't have to drive to the bank and fill out a form and wait 48 hours to get this information now. So
exactly.
So talk to me about that.
So you've hit the three major points, and customer experience first and foremost. That's just the expectation. That's what COVID and the pandemic have done, right, wrong, or indifferent. Our expectations have moved to a digital experience, and we expect answers fast.
Right.
accurate answers fast. So
and I have become one of those, because at my bank, I have so many tools at my fingertips now that I have come to love and expect that.
Yeah. And it builds trust, confidence. Those are all key things in customer retention. And so when you think about, I actually spoke with someone in the credit union space, and we were discussing customer service, and like the credit unions tend to be very member centric, but they're paying close attention to losing market share to fintechs or banks because of digital enhancements. And so now let's level the playing field where you don't have to go through the core conversion. You can have something like our modern loan servicing platform up and running in 4 months. It's very easy to stand up and see material benefits to the customer experience. So that's kind of the bucket I think that most folks pay attention to and agree on. Retention, increasing wallet share, capturing market share from the customer perspective. So we'll see a lot, and we hear this a lot of, after the pandemic, we being FIs, we automated that. What they've done is they've automated it from the customer experience. Right. And so it's easier for the customer to log in and request something, but the fulfillment is still done by a back office manual too. Right. So you talk about retention, you made it easier for the back office to get a bigger volume, right, to respond to. Right. And so that's really frustrating. And there's always been, and I remember running some of my larger shops in banking, there was a confusion about the relationship between technology and automation and job loss. Yes. Those two things are not the same, right? This is about making it easier, really protecting your employees that are not only in the back office, but empowering the ones that are in front of your customers. And that could be in the phone channel capacity or the teller front line. I have so much empathy for both sides, because those are the ones that are getting the infuriated call, and they want an answer. And it's often challenging because it involves, sending an internal message and waiting for this person to respond. And you've been told you cannot quote the payoff if it's, this product or this state or this legal status. And so we've been there, and it's uncomfortable. I've been there. And so yeah, right. So it's not a great place to be, and it does impact employee satisfaction. Do I have the tools I need to do my job? So when we talk about introducing technology and automation for operational efficiencies and gains, just as much as the customer experience, it's not headcount. It's not trying to slash jobs and lay folks off. There's enough work. Anybody in the back office will tell you, we have plenty of work. Let us go to higher value ads instead of these things that really are scalable. They're consistent policies. Technology can put the guardrails around that. So you think about a person coming in to request a due date change or a payoff quote. Those are very standard protocols of how you are going to end up at an approval or a decline. So by giving your teller or your customer service rep access to be able to go in and answer a few questions with their borrower and get to the same answer is really empowering them to solve the problem. And that's a really powerful thing for an employee. That's retention. That's employee satisfaction, right? That's how they stay with you instead of looking at their competitor because they like their job. They're doing it the right way.
Absolutely.
So I that's a soapbox of mine. Like I just, sometimes in operations, things roll downhill and it's either one back to pat or throat to choke, depending on what's going on. And it's always the folks that are really experts. They know the system, they know the loans, they know what to do. It's just the sheer volume can get in the way. So this should be a tool to empower employee experience and retention. Then the last part of that is the regulatory and compliance risk. We have heard and have experienced, best efforts, just hiccups with execution. Things are tracked in Excel databases and the Excel database gets lost in translation, or a process is kicked off by a fax and it gets left on the fax machine, or the email was a group box and nobody's used it since 2009. And so there's just all of these antiquated processes that were put in place for a reason, but now kind of expose you to some regulatory pressure. Consistency of application. You know, if you look at, and just if folks step back and say, if I had a customer come into my branch and ask for a hardship extension, and they called my phone channel and they called my collections phone channel, and then they sent me a piece of mail, would that customer in all four scenarios get the same answer? And would they get it in the same time frame?
Right.
Not always, right? Because there's a little bit of subjectivity anytime you introduce manual processing. And so with the regulatory environment, there's such an intense focus, rightly so, on consumer protection. And the regulators are looking for guardrails, scale. Can you do this efficiently and correctly? Do you have the right controls in place? Are you doing the right thing by the borrower? Are you transparent in your messaging? And so technology can really help you say, yes, we are. And here's the evidence of that proactively instead of kind of reactively to an audit finding or an exception or a complaint.
Absolutely. Here's another thing that comes to mind while you're talking about that is, I may tell the customer that the back office can probably complete that because oftentimes the customer needs it ASAP. And I might tell the customer it typically takes 24 hours or it typically takes 48 hours, whatever the procedure is. And in 24 hours, that customer's calling back because they have not received. And so they want an answer. And they want an answer right now. And so what do? We fill out another form and we send it back to the back office again. And so, it creates a backlog again. And so, it's just repeating that cycle over and over and over. And so this tool eliminates, the repetitiveness of repeat calls, confusion, and task being repeated over and over and over. So, I can't say enough good about it because I have seen, this in action, and I've seen, the stress removed from having that in place. So,
absolutely.
All right. So let's go into question number 3. And that is, what are some of the implications that we should be aware of in reference to the CFPB complaints?
Yeah. So the CFPB, we trend the CFPB complaints just about every other week, just to kind of see where there's smoke, there's fire, and what's going on from the consumer perspective. As a person who used to have to answer the CFPB complaints for a large bank, there's plenty of activity that does not necessarily mean there was wrongdoing on behalf of the bank. Everybody knows that, right? There's some strategic folks out there that will complain to the CFPB just strictly looking for kind of a last ditch effort to avoid a negative consequence on a loan. But there is quite a bit and if you read the verbatims, there's quite a bit going on that is mostly around data and reporting and status tracking and record keeping that's causing customer confusion. And I was looking at the trend line, and if you just look at the sheer volume of CFPB complaints, they are way higher than the pandemic when everybody was freaking out and calling in and trying to get some answers. And it's just a hockey stick of activity. Most of that is around credit reporting, either false information, inaccurate information, or there's a problem with clearing something on the bureau. So again, there are strategic complaints that are not material or relevant or even indicative of a bank misstep, and there are others that are materially wrong. And those are the things that data and consistency of application of policy that have a material impact on your ability to accurately report. Right, make it easy for the customer to go in and see their balance. See the amortization schedule, see the payoff statement, get the accurate balance, know what they owe for fees and principal and interest, et cetera. So that transparency can go a long way in saying, I don't have to go to the CFPB to get my answer. I can go to my bank. I can go to my credit union and go to my online banking solution and now see more data than I've ever seen before because we've implemented technology and made that accessible. So the CFPB does the same thing with their complaints, right? They see where their customers, their consumers that they are tasked with protecting are struggling. And that's what drives the regulatory agenda for audit activity. So it's in our best interest to trend it. It's certainly in an FI's best interest to pay attention on those issues, because that's what's going to show up in your audit plan in the next 12 to 18 months. So that's starting to increase. We've seen a lot of activity both on lending and servicing around UDAP and deceptive practices and unfair acts and practices. That will continue. And especially so as we start to see, as we mentioned in the beginning of the call, the increase in foreclosure and repossession activity. So, it could start with something so small that, you called for a payment and it included fees that weren't actually due, and the customer thought he made the principal and interest payment, but didn't make this, forced placed insurance payment. And that caused a 60-day mark. And then the car was put out for repossession, or it was turned off, the automatic start was turned off. Those are things that start with a very inconspicuous error and then have these downstream implications. And if at any point in that window of time before the repo, you missed an opportunity to say, hey, we can help, come in and look at what your options are. It's a very challenging story to explain to your regulator of, I'm sorry, I'm sorry that customer went outside and his car's gone. And
yes.
It's a used car market and the auction already has it and it's gone. And now what do we do? Right. And you're navigating through redemption periods and all of that. So I think it's really, you have to be able to look at your processes and your policies. Identify at the earliest opportunity, is my customer exposed? Is my consumer exposed to something going wrong in this policy or process? And if they were, do I have the tools and the communication and the strategy for them to raise their hand to me first and remediate it instead of going to the CFPB because we haven't responded or we haven't acted in an appropriate way? So that those UDAP implications, and I will say, I've implemented dozens of control frameworks. The one thing that I would stress for FIs is do your front end person, your teller, your customer service rep, your collections rep, know how to identify a UDAP violation or risk.
Mm-hmm.
They can read the policy, that's different. But do they know how to identify that when they are talking to a consumer and something seems unfair, something seems off? Do you have the culture and the steps and the protocol to raise your hand and say, I think we should look at this, something seems off, and not have that be punitive to the raising of the hand.
Mm-hmm. Totally agree. Something that comes to mind, is a credit card situation that I had. I mean, it could very easily have been a vehicle. Okay.
Mm-hmm. Yep.
So, I'm an avid user of everything is set up on bill pay. Okay. I set it up. I get something. I immediately go set it up on bill pay and it is forgotten. Okay. And so I'm going to admit I'm one of these who, I don't balance my checkbook every month. I know what's in there, but I don't balance it. Okay. And I haven't balanced it in a very long time, probably since I've had online banking. Okay. But I set a payment up on online banking. The payment amount, because I put something else on it, the payment amount went up.
Mm-hmm.
I set that payment up previously.
Just pull it. Mm-hmm.
Never thought another thing about it. But then I get a voicemail from the company asking me to give them a call.
Mm-hmm.
And immediately when I got that voicemail, I thought something's wrong.
Right.
And so at that point, I pulled up the card, looked at it, and the payment amount did not match what I was sending in. It was $25 off.
Yes. Yeah. So common. And frustrating, right? Especially for folks that are set up on ACH. They're, it wasn't a matter of cash, it was a matter of a schedule, right? Like that's it.
Yes.
And so
but for 2 months in a row, but had they not called me that would have continued. Had it been a bank, it had been a vehicle, it could have easily have been $150 difference, $200 difference. If they had come and towed off my vehicle, I would have been livid because I would not have known.
Yeah. So people are going through this with the extensions that they just received for COVID. So some folks were getting 1 or 2 months, others were getting 6 or 7, forbearance plans, deferments, et cetera. And there was very little understanding, as you saw in the CFPB complaints, over the impact of per diem and accrued interest. Yes. So folks are getting to the ends of their loans, especially if you're in the subprime area, where those per diem rates are extremely aggressive or high, that's contributing now. So you set that scheduled payment up, you think you're at the end of your loan, you pay your $400 or $500 payment, and you still owe another $200, $300, $400 in interest. Well, now you're talking about that's a whole other payment that you weren't prepared to make. Talking about a 30-day credit mark, you're talking about additional per diem on a relatively small balance, but it's just the misunderstanding in what the end was supposed to look like. The title release, the payoff, like you got to the end, you made it, and now it's this negative. You're calling the phone channel, you're filing your complaint, and all of that could have been avoided if there was just some intentional messaging that said, "Hey, heads up, you're 3 months away from your maturity date. Come on in and take a look at what that looks like. Here's a calculator. Here's a tool to help you make sure that you hit that zero balance at the final day." So we have all of this information. It's in the core platforms. Most of it, we just have to get it out. And that's where we view our partnerships with the core and the online banking providers as powerful, because the three of us can figure this out. It's just been missing that middle piece. And so it's been somewhat transformational, both from customer and employee experience to figure this out. Decade-old problem, but we'll tackle it.
I love that. What a ton of information today.
Yes.
A lot of information for our banks, a lot for our consumers, and what to expect over, the next few quarters. But again, I think the impact of that is going to impact us for months ahead. And just not knowing then what to expect even a year from now. Right. So Carissa, any parting words as we come towards the end of the podcast today? Any any positive story that you want to leave for our listeners today?
Sure. Yeah, I think this has been great to talk about. And I think the more folks that talk openly and candidly about the fact that we're all a little unsure about the next couple of quarters, the better prepared we'll be in how to manage that. So I think everybody is hopeful, but also cautiously optimistic about what the next couple quarters will look like for loss projections. And also just as consumers of, will prices go down? Will we still be paying $5 a gallon at the gas pumps? So there's this real sense of we're all in this kind of similar space, and this real, I hope, not just because the regulators are kind of pushing us this way, but there's a real sense of collaboration on how we navigate the next couple quarters. And I'm hopeful that this will go a lot better than how we exited the Great Recession and that emergency period of time from a financial perspective.
Yes, absolutely. Well, I appreciate you joining us once again. I always love visiting with you, and you always have such great knowledge. And coming from a large bank, you understand what the bankers are going through. You also understand what the consumers are going through. And I love that about you. Love working with your company. And so with that, for those of you that are listening today, if you have questions, feel free to leave them in the comments, or if you got something out of this today, leave it in the comments. And if you would like to reach out to Carissa or myself, we will leave both emails in the show notes of today's podcast. And we would love for you to share the podcast with friends, families, other potential listeners. And with that, we will leave you for today and look forward to you joining us on other Performance Banker podcast in the future. Thank you, and we'll see you soon.
Thanks for listening. Be sure to download and subscribe wherever you get your shows. Find more content on our YouTube channel. Link is in the show notes. This podcast is sponsored by GossagePerformanceConsulting.com.